Picture this. It's 2008, and the unthinkable actually happens. Homeowners wake up to find out their biggest asset has suddenly dropped in value by half. Banks are collapsing. The stock market is in an absolute freefall. The sheer panic and economic destruction felt during those months was literally unprecedented in our modern era.
So the big question we're exploring in today's Explainer is exactly that. How in the world did a localized U.S. housing problem manage to spiral so completely out of control that it nearly took down the entire global economy? We're diving into the story of the 2008 financial crisis. And trust me, this isn't just history. It is a massive, incredibly important lesson in systemic risk.
Section 1. The housing market boom. All right, to really understand this crash, we've got to look at the environment that made it all possible. Back in the early 2000s, interest rates hit rock bottom, and banks basically opened the floodgates for borrowing. Because credit was so incredibly cheap, demand just skyrocketed. And this birthed a really dangerous, widespread delusion. People literally believed that U.S. house prices would simply never fall. Housing transformed from a place to live into this supposedly fail-proof investment machine.
Section 2. Subprime mortgages and hidden risks.
Now, to keep this massive money machine running, lenders needed a constant stream of new borrowers. So, what did they do? They lowered their standards. They started offering what are called subprime mortgages to borrowers with low incomes and pretty poor credit histories. Under normal conditions, banks wouldn't touch these risky profiles with a 10-foot pole, but the old rules of lending were being rewritten in real time to keep the boom going.
It was a total paradigm shift. The traditional banking playbook, rejecting risky borrowers to protect the institution, was flipped completely upside down. The 2008 strategy was basically just approve everyone. Lenders assumed that even if a subprime borrower didn't pay, the bank was totally safe because they could just foreclose and sell the appreciating house at a profit. To everyone involved, it felt like a magical system with zero downside.
But here's the catch. Local banks didn't actually want to hold on to these risky loans. Enter one of the most catastrophic financial innovations of our time, the mortgage-backed security. Financial institutions started taking thousands of individual home loans, mashing them together and bundling them into a single, massive financial product. This essentially masks just how toxic that underlying debt really was.
And this created an absolute beast of a global pipeline. Here's how it worked. A local bank issues a risky subprime loan. Then Wall Street bundles those loans into securities. Finally, those supposedly safe securities, which, by the way, were often stamped with top-tier gold star ratings, are sold to global investors. We're talking pension funds, massive insurance companies, even foreign governments. So the local risk wasn't eliminated at all. It was just disguised, chopped up, and injected directly into the global financial bloodstream.
Section 3. The housing bubble bursts.
And then the supposedly impossible happened. Home prices just stopped rising. At the exact same time, interest rates crept up, which meant those monthly mortgage payments suddenly got vastly more expensive for folks with adjustable rate subprime loans. Millions of people realized they couldn't afford to pay. Foreclosures went through the roof. But because everyone was defaulting at the exact same time, the market was absolutely flooded with houses, and nobody wanted to buy them. The basic law of supply and demand violently pulled house prices right back down to earth.
Section 4. The global financial collapse.
You guys, the dominoes fell with terrifying speed here. Let's track it. Phase 1, home prices fall and borrowers default. Phase 2, because those underlying loans are failing, those bundled mortgage-backed securities rapidly lose their value. Phase 3, major banks worldwide suddenly wake up to realize they are holding billions in toxic assets, which triggers Phase 4, an absolute freeze in interbank lending. Institutions completely lost trust in each other's ability to survive. And finally, Phase 5. Without credit flowing, businesses can't operate and the entire global financial system just grinds to a halt. All of this incredible pressure finally detonated on one very specific, highly consequential date, September 15, 2008. On this day, Lehman Brothers, one of America's oldest and largest investment banks, filed for bankruptcy. And overnight, it became the single biggest bankruptcy in U.S. history. I mean, the visuals were just stunning. Footage of employees carrying cardboard boxes out of massive skyscrapers was broadcast everywhere. Panic aggressively spread across the financial markets. Stocks crashed violently as terrified investors scrambled to liquidate absolutely everything they could get their hands on. Financial confidence, which is literally the glue that holds the whole global economy together, just disappeared. And suddenly, this wasn't just a Wall Street problem anymore. It became a very real Main Street crisis. The contagion spread worldwide, triggering a severe global recession.
Credit dried up entirely, factories shut their doors, and millions of everyday workers lost their jobs as international trade and stock markets simultaneously nosedived.
To stop modern society from a total financial meltdown, governments and central banks had to step in. They slashed interest rates down to zero and injected trillions, yes, trillions with a T, of bailout dollars into the financial system, essentially putting the global economy on life support. Now, the immediate bleeding stopped, but the devastating economic scars from this, they lingered for a solid decade.
Section 5. Lessons from the crash.
So looking back at the wreckage of 2008, we're left with a pretty undeniable checklist of failures. First, artificially easy credit fuels incredibly dangerous, unsustainable bubbles. Second, complexity is very often just a mask for extreme risk. If an institution doesn't fully understand a bundled product, they really have no business trading it. And third, without rigorous oversight and regulation, blind greed is absolutely going to outpace institutional caution every single time. But maybe the most enduring takeaway here is actually about human psychology. When too many people believe prices can only go up, the biggest crash may be just around the corner. Blind optimism is the ultimate precursor to disaster. When the entire market assumes an asset class is perfectly safe, well, that is exactly when the system is most vulnerable to a sudden shock. Which brings us to our final thought for this explainer. Studying this financial history isn't just an exercise in looking backward, right? It's about equipping ourselves for the future. Are we recognizing the warning signs of the next crisis? Because understanding the really volatile intersection of money, credit, and human behavior is probably the most vital investment you can possibly make. Keep questioning the consensus and keep your eyes open.